Today, I want to talk about a company that some consider a monopoly in the world of 3D modeling software. From its flagship CAD program to Maya and ZBrush, this company has led the industry for decades without any real major competitors. Today, we're talking about Autodesk and asking the question, how does this massive 3D titan continue to grow? Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. If you've ever worked with any kind of 3D software, then chances are you've come across Autodesk. Its products are used in many different professions, from engineering to art, gaming, 3D modeling, architecture, and more. You can build massive skyscrapers or even model fish swimming in a pond. Originally, when Autodesk was formed in 1982, it only had one program, AutoCAD, its most well-known product. Over the years, though, it expanded its product line and acquired other companies to integrate with these programs, like Maya and ZBrush. The company became as big and as much a staple as another company also started in 1982, Adobe, and has also even adopted the same payment model. Like Adobe too, Autodesk products have always been notoriously expensive, yet as of 2015, the company announced it moved to the subscription-based model. Again, much like Adobe, Autodesk cited the lack of customers willing to spend a large ticket price for a perpetual license as one of the reasons for the change. This move has proved extremely beneficial to the company's top and bottom line. And really, Autodesk has virtually no major competitors to threaten its throne. Much like its 2D counterpart, Adobe, Autodesk offers such a massive array of products that no other company can truly compete. Plus, it just buys up many of its competitors, then integrates them into its own ecosystem of products. For example, the company acquired 4 other companies for this exact reason over the last year. Even so, with this near monopoly, I want to take a look at Autodesk's financial health. First up is revenue growth. In 2015, the company brought in just $2.5 billion. Last year, that number had grown to $3.66 billion, but just keep in mind that the large revenue jump from 2019 to 2020 could be attributed to the certain unfortunate worldwide events. Second on the list is shares outstanding. In 2015, the company had 227.1 million shares outstanding. At the close of last year, that number had been reduced to 219.4 million shares outstanding. In other words, Autodesk has bought back some shares. Although not a lot, it's still a good trend to see. Over the last 5 years, Autodesk has grown its free cash flow, going from $341.6 million in 2015 to $1.34 billion in 2020. This makes sense given the jump in revenue and the decrease in expenses as a result of last year. Next on the list is current assets versus current liabilities. Right now, Autodesk's current assets total $1.55 billion against $3.1 billion in current liabilities, with $924 million in cash. Not great to see, honestly. With all of its recent acquisitions, many of the company's debts are due soon. Now, let's get into a rough company valuation using our free cash flow model. If we take the average of the last 5 years of free cash flow of $611.4 million and multiply it by 20, we get an expected market cap of $12.2 billion. Currently, Autodesk's market cap is over $71 billion. Given its position in the market and its market share, it sort of makes sense investors would give it such a high valuation. Taking a look at Autodesk's 5-year return on invested capital, we see that the company stands at an impressive 17.6%, well above our goal of 9%. 2020's ROIC was even better at 37.5%, telling us that Autodesk is very good at using capital to grow its business. To wrap up our look at the financials, Autodesk does not pay a dividend. Overall, on the surface, a solid company, although with potential debt issues. Now let's take a look at some of the reasons why you may or may not want to invest in Autodesk. To begin, when I say Autodesk is a monopoly, I don't mean a complete monopoly, not the kind that has absolute reign over everything in its market, like the board game. What I mean is that there are virtually no companies that compete with Autodesk on its level. Companies like SolidWorks, Bentley, and Ansys all offer competing products, but lack the level of integration and development of Autodesk's offering. Actually, there are competing programs for every one of its products. Nevertheless, Autodesk is the leader in most of these programs and the industry as a whole. The monopoly isn't on the products per se, it's on the integration of these products, much like Adobe. Autodesk is considered the industry standard by many of the top movie studios, game developers, and architects. Its products integrate so well together that these industries prefer the company's products overall. That kind of integration, brand recognition, and reputation allowed Autodesk to grow steadily over the last few decades, yet most of the company's current growth seems to be through acquisitions, devouring rivals only to integrate their offerings into its own network of products or offered as the few standalones customers can use. In terms of acquisitions, Upchain is Autodesk's most recent purchase, and it makes sense, falling in line with the whole integration model. Upchain specifically is designed to centralize the company's workflow using the cloud. Having it in the product line allows seamless transitions between Autodesk's various programs and users. We just don't really know how much the company paid for Upchain because that was never made public. Plus, with Autodesk's lineup heavily focused in 3D modeling, it also makes sense that it bought Solid Angle. If you've ever rendered any kind of 3D for animation, games, you name it, or ever learned how long it takes, Solid Angle's acquisition makes even more sense. Its flagship program, Arnold, was designed to render 3D animation and visual effects faster, overall decreasing render time and streamlining workflow. That helps incredibly well with Autodesk software like Maya and ZBrush. Yet not every investor is a fan of this growth by acquisitions model. For me, it's not that big a deal, especially considering Autodesk's 3D CAD total addressable market. Taking a closer look, 3D's total market was estimated at $9.46 billion in 2020. However, projections put the total market at $15.4 billion by 2028. In other words, it looks like demand will grow about 6.5% every year over the next 8 years. Autodesk will probably capture about half that growth, but for the company itself to continue to grow at the rate it has, it definitely needs that growth by acquisition model. Because if we're honest here, that model has worked very well for Autodesk. All we need to do is take a look at its ROIC. That 5-year average is 17.6%. Again, impressive, and suggests that the company is effectively using its cash to grow. And really, you could say that's the main bull case for Autodesk. In order to continue to grow, however slowly, this titan needs to lap up companies for seamless integration and overall revenue growth. It's not like investors skeptical of this acquisition growth model are off the mark. It does come with legitimate concerns. Usually, growth by acquisition models can work very well. You can see it for companies like Berkshire Hathaway and Constellation Software. Their growth largely comes from acquisitions. On the flip side of that, you have the model failing, as in the case with AT&T, a company that has spent fortunes on acquisitions and still hasn't really gotten anywhere. And therein lies the danger. Management has to be exceptionally capable at deciding which companies to acquire and for what purposes. I don't think Autodesk's corporate reward structure is conducive to that end. With most large publicly traded companies, the directors customarily receive stock and options based on performance metrics. It rewards CEOs and board members for growing the company, but Autodesk takes it to an extreme. Around 85% of executive salaries come from stock and options, and the only metric required is simple: revenue growth. This can be downright dangerous. Typically, you want to incentivize directors to grow earnings per share or return on assets through new customers acquired or customers converted to subscription-based, or a mix of all of these. If your only incentive is to grow revenue, then you'd simply grow revenue through any means, and the easiest way to do this is through acquisitions. Any price paid for any company is justified because you grew the revenue. This was definitely reflected in Autodesk's balance sheet throughout 2019 and 2020. The debt to equity was absolutely decimated. From 2018 to 2020, the company acquired or invested in 7 different companies. Growing revenue through acquisitions during this time essentially destroyed shareholder equity, leading to a negative debt to equity ratio for a solid 2 years. Thankfully, in 2021, the company managed to curb some of this lunacy. Still, Autodesk's debt to equity remains at 134%, or way more debt than total shareholder value. Yes, I think you can draw a line from revenue-based compensation to the destruction of shareholder value, and yes, I do think Autodesk's managed to make smart, solid acquisitions, but to reward its directors based purely on revenue growth is irresponsible, so I see how skeptical investors are concerned with this acquisition-based growth model. So the question is, am I buying Autodesk? The answer? No, I'm pretty much avoiding it altogether. My first and primary reason is that I personally believe the management team of this great, slow-growing titan is not optimized to make good acquisitions conditions due to their compensation methods. Along with this, you would need experienced and well-versed directors who understand the company. The average tenure of a director at Autodesk is roughly 1 year. 1 year. Can you have a director for 1 year who is both experienced and well-versed in the company that can make capable decisions? Well, maybe, but how likely do you think it is given what's happened to Autodesk's debt to equity? The other issue I have is with the extreme overvaluation given to this relatively unimpressive company. Using a discounted free cash flow model, we get a valuation of around $200 a share, assuming Autodesk grows its free cash flow by 14% a year. I'm not sold though. If anything, I think it's going to be between the 6 and 7% range. I know it also seems like I'm selling Autodesk short, but I just don't see personally how it can continue to grow revenue or free cash the way its management has in the past. It's not the acquisition model that concerns me, but the same management team and its irresponsible reward system. Again, personally, I won't buy or want to buy any shares until the price is well below $80. While it seems like a steep drop, that's my personal range. Go out and do your own research. Determine if Autodesk is something you want to add to or avoid for your portfolio. If anything, I hope you'll use this video as a launching point. Plus, if there's anything I happen to miss that you discover or know, let me know in the comments section or hop onto my Discord. I'm always down for a discussion. Link in the description. All that said, thanks for watching this video on Autodesk. I'll see all of you in the next installment of Dollars and Cents.